Hello and welcome back to our 11th educational series on commercial real estate. Actually, if you count the one we did on commercial market cycles, this is the 12th one. We plan to do at least 15 of these. And after that, we're going to roll out the crystal ball and look at market conditions live. So we'll be doing series on market conditions. Up to now and so far, we've discussed a lot of fundamentals for commercial real estate. Today, we'll be stepping into the shoes of an investor/owner and decide what we would do if we were him or her. We're going to use and apply everything that we've learned so far, and we'll be applying it to a real life situation that we will be facing. So stick with me. I'm your host, Brian Shakarami, and let's get started. I want you to imagine this scenario. Several years ago, you purchased a commercial building and you've been the proud owner of it since. This is obviously your investment. But if you take a step back and think about it, at some point in time, you'll come to a fork in the road to where you have to make some decisions. Decisions about your investment. And you have to be honest with yourself and ask yourself, do I just want to continue to hold this property and not do anything with it? Do I want to continue to hold this property but at least refinance it? Or do I want to exchange it with another property? What we just went over is a real life scenario, a real life issue. So the question is, how do you find out? In engineering school, I was always told when all else fails, you go back to the basics. To answer our questions, we have to start with the basics. And the basics, of course, always start with a cash flow analysis, followed by a discovery process. Because cash flow is only a stepping stone to completing our analysis. To complete our discovery process and fine-tune our analysis and come to some conclusions, we need to know what our sale proceeds would be if we were to sell the building today. This is foundational. We have to know our cash flow for continuing to own and not doing anything with it is. We have to know the cash flow if we were to refinance it. And of course, we need to know the cash flow of a like-kind exchange, which is referred to as a 1031 exchange. And by like-kind, I mean real estate and real estate. I don't mean real estate and an airplane or a motor vehicle. So once we have the answer to all of this, we can then calculate their respective internal rate of returns or the IRRs and compare them. Or we can compare their capital accumulations or their accumulation of wealth to help us decide whether we should keep it, sell it, or exchange it. There are, of course, other financial indicators to help us with our decision. These indicators are things like the acquisition capitalization rate or the cap rate, the interest rate or the discount rate, the internal rate of return before and after tax, the effective tax rate as a result of the IRRs, the growth rate of our capital, our cost of funds, both before and after tax, our cash on cash, generally after tax, or it could also be before tax, and our gross rent multiplier. As always, we will drive our points home with an example. We'll start with Trump Twin Tower or T-Cube building. We have already owned T-Cube for the past 5 years, and therefore it would make sense for us to consider 3 scenarios. The first one, of course, is to do nothing and continue to hold the property. The second would be to refinance the property and continue to hold it for another 5 years. And lastly, we would exchange the property with another property of a higher value and hold that for 5 years. So let's look at our example. Trump Enterprises has owned T-Cube for the last 5 years. The company has received a firm offer in the amount of $65 million from a buyer keenly interested in purchasing T-Cube. You work for Trump Enterprises as a real estate analyst, and you've been asked to do an analysis in order to find out if it would be better to 1. Sell T-Cube today at today's offering price. 2. Hold T-Cube for the next 5 years. 3. Hold T-Cube for the next 5 years but refinance it. And 4. Exchange T-Cube for another property. Trump Enterprises accounting department has provided pertinent information to assist you in your analysis. As always, your failure to provide a solid analysis will cause Mr. Trump to fire you. We have been provided with a few financial assumptions. The first one here in yellow is the company's tax rates and brackets, in addition to its weighted average cost of capital used for reinvestments of any sort. In the navy blue is our property assumption. What we purchased it at, our acquisition cost, the net operating income at purchase, the annual escalation rate for the net operating income, the improvement allocation, sale price if we were to sell it today, the cost of sale if we were to sell it today, the total cost recovery recapture taken so far, and the full year and partial year cost recovery recapture amounts. We've also been provided with the disposition cap rate at the end of year 5 at 7% and our projected end of year 5 cost of sale. Down below in red, we have our financing assumptions, which starts with a loan to value ratio of 80%, an interest or discount rate of 6%. The amortization of our loan is 20 years, loan term is 10 years, and we have loan costs of 2%. For our hold and do nothing scenario in black, our refinancing assumptions are that we would get a new loan in the amount of $46 million at an interest rate or a discount rate of 5.5%. Our amortization period would still be 20 years, but our loan term would be 5 years. And the old loan balance to pay off to get a new loan would be $38,035,020. New loan costs are at 2%. Here in blue is the information on the exchange property. The cost of the new property is $90 million. The acquisition cost is provided. Every exchange has an intermediary fee which is provided. The net operating income for the first year is provided. The annual escalation of the net operating income is provided. And of course, the improvement allocation is provided as well. The disposition cap rate used to calculate the sale price is also provided, as well as the projected end of year 5 cost of sale. For the exchange, they've also provided the equity transferred, which is the price of sale before taxes, because in an exchange, we don't pay taxes. That's the whole reason we do the exchange. In dark red is our financing assumption for the exchange building. We can finance this new building up to 75% of its purchase price. Our discount rate for this new building is provided, the amortization of 20 years, loan term 10 years, and loan costs are at 2%. So they have provided a whole lot of information, and we have to make some sense out of all these numbers that they have provided. To do the analysis for our 3 scenarios, it is imperative and foundational for us to have our investment basis. Therefore, that's what we will start with. This investment basis, of course, is the sale proceeds after tax of selling our property today, and hence our sale proceeds today. Therefore, it is a no-brainer that we will need the alternative cash sales worksheet for the old building. And that's the first thing that we have developed as follows. From this worksheet, we have our sale proceed after tax here, and we have also calculated our sale proceeds before tax, which is used for exchange purposes. Let me emphasize again, this is the sale proceeds after tax if our property was sold today. And this brings our investment basis to $23,068,944. So now that we have our investment basis, we can move forward to working on each of our investment scenarios. And we will start with scenario 1, hold and do nothing. Remember that we've already held the property for 5 years. Now you've decided to hold it for another 5 years. To get to our cash flow, we need to develop what's called an annual property operating data sheet, or APOD. Here's our APOD. We are currently at the end of year 5 and we're moving forward with another 5 years of ownership, all the way to year 10. This is where we would presumably sell the property. Our net operating income then must be projected to year 11 for us to be able to calculate the sale price at the end of year 10. Remember that the purchaser always looks at the NOI of the first year of ownership to ballpark the purchase price. Therefore, the sale price at year 10 uses the NOI of year 11. We have one mortgage here, and the associated interest payments are carried out all the way to year 10. Our cost recovery recapture is also carried out for 10 years. We have a 10-year loan term, therefore the cost of our loan is also amortized and carried for 10 years. We can now calculate our taxable income for our real estate holding, and therefore our tax liability, which is at 21%. Our annual debt service was provided, and we carry this for 10 years. From here, therefore, it is easy to calculate our cash flow before and after tax. To come up with a sale price for the hold and do nothing scenario, we need to do an alternative cash sales worksheet. To do this, we need to project a sale price, and that sale price would be at the end of year 5 of this new loan, which would mean that we have owned the building for 10 years. As I mentioned before, our projected sale price would be the ratio of the net operating income of year 6 to our disposition cap rate. Year 6, remember, is 1 year after our second 5 years of holding, or you may think of it as year 11. And lo and behold, we come up with our sale price at the end of year 5. And this leads to a projected sale price of $84,081,000, rounded to the nearest 1,000. Now that we have all the pertinent numbers, it is easy for us to complete our alternative cash sale worksheet and come up with the sale price, as well as calculate our internal rate of return and our net present values. This is our alternative cash sales worksheet. We have the sale proceeds before and after tax. Everything we did so far were necessities. They are, for the lack of a better word, our tools. We need these tools to do our analysis. We need and must have our initial investment, our cash flows, and our sale proceeds both before and after tax. So from these numbers, our cash flow, our initial investment, and our sale, we can then calculate our internal rate of return both for before and after tax. From that, we can calculate our effective tax rate. Here, we've calculated our costs of funds before tax. This is based on our new loan of $44,800,000. Based on our tax bracket, we were then able to find the cost of funds after tax. We then used our initial investment, cash flows, and the sale price, and our investment rate of 7% to calculate our capital accumulation and our growth rate of capital at 18.32%. Let's simplify this chart. This is our capital accumulation, capital growth rate of 18.32%, and our capital accumulation of $53,485,683. We have just completed the analysis for scenario 1. We now move to scenario 2. Hold the building for another 5 years and refinance it. Again, remember that we've already held the property for 5 years. Now we've decided to hold it for another 5 years, but refinance it. And of course, when we refinance, we pay off the old loan. We are 5 years into the ownership, therefore we need the balance of the old loan at the end of year 5. So the old loan has a remaining balance of $38,035,020 at the end of 5 years, and we're going to have to pay this off. And we start with a $46 million new loan. Doing this will change our investment basis for sure, and therefore we'll have a new investment basis. And here's how we arrive at the new investment basis. We take out the new loan, subtract the old loan, subtract the loan cost, and what's left is what money we have taken out in cash. So therefore, we take our old investment base of $23,068,944 and we subtract the cash that we took out. And therefore, our new investment basis would be $16,023,964. Here are some pertinent information on the new loan. The new loan amount, the loan balance at the end of 5 years, our periodic payments, which includes principal and interest, our mortgage interest payments for 5 years, because at this point we are planning to hold on to the building for another 5 years, and our cost recovery recapture, which doesn't really have anything to do with the loan, but the information has been calculated here. From here, it is easy for us to work on our cash flow or APOD. As before, we will move to calculate our projected sale price at the end of year 5 of this new loan. This number is basically the same as under the hold and do nothing scenario. We can then develop our alternative cash sales worksheet, and from there we come up with our sale proceeds before and after tax. And now that we have all the numbers, the initial investment, the sale price, and the cash flows, it is easy for us to calculate our internal rate of return both before and after tax. And from there, it is easy for us to calculate our effective tax rate. We then move to calculate the costs of funds both before and after tax. We then move to calculate our capital accumulation, and we see that we have a capital accumulation of $44,472,757, which gives us a growth rate of 22.65% for our capital. Let's simplify this chart. Here's our initial investment. Here's our capital accumulation at a reinvestment rate of 7%. Our capital growth rate is 22.65%. Our capital accumulation, again, is $44,472,757. However, there is a problem here, as this is not the entire picture. Remember, when we financed, we took out some cash, about $7,044,980 worth of cash. To compare apples and apples, for our capital accumulation, we must account for this cash. We account for it by reinvesting this cash for 5 years at our 7% reinvestment rate and come up with our capital accumulation for this cash at the end of 5 years. And that is $9,880,949. To get a total picture, we must add the capital accumulation of the real estate and of the cash taken out. And therefore, our total accumulation starts with our investment of $23,068,944 and ends with the capital accumulation of $54,353,706. This gives us a capital growth rate of 18.7%. And it concludes our analysis for scenario 2. Moving on to scenario 3, the exchange. So here we're getting rid of the old property, much like a sale. And we're picking up a new property, much like a new purchase. But although we're buying and selling in reality, we're not going to call it that. We're going to consider it a swap, and we'll call it an exchange. Only in America. Because if we call it an exchange, then we can avoid paying taxes at the time this transaction takes place. And therefore, we defer the taxes until the actual time when we actually sell the building and don't buy anything else. The name of the game is to defer your taxes until you die. It is completely legal and blessed by the Internal Revenue Service under Code Section 1031 Exchange. But Code 1031 has some rules. This is, of course, a lot more complicated for me to discuss all of it here. and warrants a new segment on the 1031 exchange. But for now, we will cover a few foundational basics. In short, an exchange must be like-kind. That's why they call it like-kind exchange. It means that you cannot exchange a building for a car or an airplane or a boat. The new property that you're going to purchase must be identified and designated within 45 days of the sale of the old property. And the new and therefore replacement property must be closed on within 180 days of the sale of the old property. And finally, the purchase price and the new loan for the replacement property must be equal or higher than the old property being exchanged. So back to our scenario. We sold our property and we've identified, designated, and purchased a new property, and we've secured new financing. Well, this totally changes the ball game. And here's what I mean. We're going to hold this exchange property and sell it at the end of 5 years. So we need to calculate our new internal rate of return and capital accumulation. To do this, we are going to need the annual property operating cash flows as well as the alternative cash sale worksheet. To achieve this, we have to go through a 4-step process. And 1, we have to find our investment base, which we already have from before. 2, we have to find a new investment basis. But now that we're dealing with a new building, we call this the substitute basis. 3, we have to find our new cost recovery amounts. And finally, we need information on our new loan amount. We will start with step 1, which is the investment basis. This is basically the sale proceeds before tax of our old property. We use this before tax is because the whole reason you're doing this exchange is to avoid and defer taxes. And therefore your sale proceeds before tax will be your equity transferred in to the new deal. $25,664,980. We will also need our adjusted basis of sale of the old property to use in our exchange analysis. Now we move to step 2, calculating our substitute basis. This is the information for the property we're purchasing through the exchange. To develop our substitute basis, we have to have the realized gain from the sale of the old building, the one that we're not going to pay taxes on, at least not yet. Once we figure this out, we deduct it from the value of our newly acquired property to find our substitute basis. Since we did not have any recognized gains, something that we'll have to pay taxes on, such as cash or booth or net loan relief, our recognized gain will be the same as our realized gain. So here we did not have any recognized gain, and therefore our substitute basis is basically the value of our property plus its acquisition cost minus its unrecognized gain. And therefore our substitute basis will be $79,587,925. Now that we have our substitute basis, we move to step 3, calculating our new cost recovery recapture figures. The recovery figures, both for partial year and full year, will be based on the new substitute basis, as depicted here. Moving on to step 4, we need the new loan amount and all the pertinent information that goes with it for our cash flow calculations. We are buying a new building for $90 million. We have acquisition costs of $1.8 million. We have exchange intermediary fees of $150,000. We add these up, these are our total costs. And we subtract the equity, the money that we've transferred in from the old property, which was the sale price before taxes. And that was $25,664,980. Therefore, the new loan that we're going to need for this new building will be $66,285,020. To do our cash flow worksheet, we need to amortize our cost of loan, which means we need to find it first. We know that we have a 2% loan cost, therefore we can figure out what our gross loan amount is. From there, we can figure out our loan cost by subtracting our net loan from our gross loan. Therefore, we will have a loan cost of $1,352,756 amortized over 10 years. This is our new loan information. The loan amount, loan balance at the end of 5 years when we sell the property or supposedly sell the property, our periodic payments, annual debt service, and the loan cost where we just calculated, as well as the interest payments for years 1 through year 5. Now that we have all these numbers, it is easy to develop our annual property operating cash flows, or APOT, and the alternative cash sale worksheet, which we will need for our analysis. Note that we have a 10-year loan term here, but we sell this property at the end of 5 years. Therefore, we would have amortized only half of our loan costs and will have to account for the other half under unamortized loan costs in our alternative cash sales worksheet. Now it's time to project our sale price at the end of year 5. And this is done using the net operating income of year 6 along with the disposition cap rate. And we have rounded it to the nearest $1,000. And our sales price would then be $164,077,641, rounded to the nearest 1,000. We now have all the numbers that we need to develop our alternative cash sales worksheet. So therefore, we can arrive at our sale proceeds before tax and after tax. And this provides us all the information we need to calculate our internal rate of return before and after tax, as well as the effective tax rate. We then calculate our cost of funds before tax, as well as our cost of funds after tax. Moving on to the capital accumulation, we see that our capital accumulation for the exchange property is $104,386,541, giving us a capital growth rate of 35.25%. Here's a simplified version of it. And this concludes our analysis for scenario 3. And now that we've done all these analyses, it's time for some comparisons. Take a look at this capital accumulation comparison. Look at the hold and do nothing, $53,485,000. Hold and refinance, $54,353,000. And look at the exchange, a whopping $104,386,000. This is why 1031 exchange is so important, and this is why real estate is such a great vehicle for building wealth. Now let's look at this comparison as a whole among the 3 scenarios. We alluded to a bunch of criteria that can be used to assist us in our financial decision making. This summary covers all of them. If you're going to make the right investment decision, you should have all the facts and figures in a concise and discernible format to allow you to easily and logically do this. In this segment, we covered the financial analysis of one building under 3 different scenarios. Prior to performing our analysis, it was imperative that we compute our investment basis, which came from the after-tax sale proceeds if the building were to be sold today. From here, we analyzed doing nothing and continuing to hold the property. We also analyzed refinancing, but still continuing to hold the property. And finally, we analyzed exchanging the property for another property. As always, if you have any questions regarding what we just discussed, please send me an email to the following link and I'll be happy to get back to you. Thank you for your time.